So, ladies and gentlemen, dear friends of BRS, the Belgian Raiffeisen Foundation, I wish you all a warm welcome to this 9th edition of the Microfinance Lunch Break. And with this 9th edition, here in Brussels, and the highest presence ever, these Microfinance Lunch Breaks have become a landmark in the Belgian financial circles, as they are already for quite some time in Luxembourg, where ADA, our highly estimated partner, is the organizer. And I address a special welcome to Mr. Arnaud Servet, who is the new CEO of ADA and his first presence here in Brussels. As a lot of you already are aware of, the aim of the Microfinance Lunch Break is to raise the awareness and to increase the interest for the challenging world of microfinance and microinsurance. Today, we go already through the 9th edition, and you can state there is an ever-increasing interest for the subject. As promised earlier, we will try and alternate the subject between microfinance on the one hand and microinsurance on the other. BRS is convinced that with ADA, Febelfin, Assuralia, KBC and SERA, it has strong partners who are convinced of the important role microfinance and microinsurance plays and has to play in the future, and are willing to support this initiative very actively. I especially would like to thank KBC, our valued partner of BRS, for their support and for their generous hospitality for our Microfinance Lunch Breaks. We kicked off the first edition of the Microfinance Lunch Break in February 2009 with Damien van Stauffenberg from Microrate, who dealt with the issue of the impact of the financial crisis on microfinance. Since then, through a number of well-known and experienced speakers in the review, we discussed a variety of issues of the world of microfinance and microinsurance, ranging, amongst others, from regulation over risk coping mechanisms to governance issues and so on. And so, we are here today again with a new question. Interest rates in microfinance, abuse or necessity? Question mark. The debate on interest rates today for sure is not new, but yet still very relevant. Over the past 2 decades, institutions that make microloans to low-income borrowers in developing and transition economies have focused increasingly on making their operations financially sustainable by charging interest rates that are high enough to cover all their costs. They argue doing so will best ensure the permanence and expansion of the services they provide. Since the real uplift of modern microfinance in the 70s, there has been criticism about these interest rates. These rates are in general much higher than charged by traditional banks. And this is mainly explained by the high costs involved with tiny loans. But still the debate continues, especially these years as there is a growing number of regulations aiming at putting a cap on interest rates. Or also because of the suspicious way the public is looking at the growing number of commercial societies involved in microfinance. The question remains, how can microfinance pretend to contribute to economic progress as well as to social goals in developing countries while charging interest rates ranging between 30% and 70%. Abuse, necessity, or something else? Today's debate will focus on the important issue and evergreen debate of interest rates in microfinance. Really abuse or necessity? This challenge will be addressed by our 200 panel members of today, Mr. Aldo Moro and Professor Marek Hudden. Mr. Aldo Moro is a financial economist and has directed his professional preparation and experience during the past 15 years towards SMEs and microfinance. He's a founding member and the executive director of Microfinance Rating, an international rating agency specialized in microfinance. Aldo Moro has an in-depth experience in rating microfinance institutions. He realized more than 150 evaluation missions in the 4 continents. And before joining the company, he has worked for 4 years as microfinance portfolio manager at Etimos, an international financial consortium with a social mission. Our second panel member, Professor Marek Hudden, holds a PhD in Economics and Management Sciences and a Master in Philosophy. He is currently professor at the Solvay Brussels School of Economics and Management, and he has initiated the European Microfinance Program, a one-year master's degree in microfinance co-organized by 4 European universities, and he is still today coordinator of this master. He is also coordinator and co-director of the Center for European Research in Microfinance and the Centre d'études économiques et sociales de l'environnement. So, ladies and gentlemen, dear friends, once again, we have a challenging subject and renowned panel members. Together with you, I'm looking forward to a fascinating discussion. And after the panel debate, there will be a question and answer session, followed by some closing remarks addressed by Thomas Leijzen, Chairman of the Board of Directors of KBC Group. I now give the floor to Kurt Moers, our Program Director at BRS, who will moderate the debate. Kurt, the floor is yours.
Good afternoon. I would like to invite our both guest speakers today to take a seat. And to make it easy for you, they will sit in alphabetical order. Aldo at your left side, Marek at your right side. So Aldo from Microrate and from the academic world, Marek. I received quite a number of questions from a number of people here in this room, so thanks for that. I think we can easily have more than one session today, so sometimes I had to skip some questions, like how do you start microfinance in Belgium? But there are some people perhaps during the break afterwards. But there is also one other category that I had to skip, that was how do you calculate an interest rate? And I know this is a very technical question and there are many ways of doing so, but we will not go into that kind of technical details today. When we talk today about interest rates, it's all included. It's all effective interest rates, all the additional costs, not only the one that you see on the leaflet if you go to the microfinance institution as a client. Is it declining or flat? Is it upfront or bullet repayment? We will not go into that kind of discussion. I can perhaps refer to the Microfinance Transparency website, where you can see all ways of calculating interest rates. But as Mr. De Pieker introduced the topic of today it's a question, is it abusive, microfinance interest rates necessary, or something else? So let's go to one specific graph, and then, of course, I will not talk all the time. This is how it's published in the recent publication. You have all a copy of this, or if you don't have, outside there are still some available, from a recent publication on microcredit interest rates and their determinants. Here, this is the, let's say, an average or the median of quite a number of microfinance institutions worldwide. And the first question will go to you, Marek. One definition is a microfinance institution has to cover its costs. And just to give you an idea, in order to give a loan of 100, it does cost 14 in operational cost, nearly 8 for financial expenses, 3 for losses. And if they take a profit of only 2.6%, then you can see that organizations are not becoming rich by offering microfinance loans at 27%. So some people say this is a fair interest rate if the profit is not too high, above all these costs. So question to you, Marek, is that your definition of a fair interest rate too?
Thanks for this introduction. So first, thanks for inviting me here. I'm very pleased to be here, extremely pleased to be here also because we are very happy partners with BRS and with ADA in the Open Microfinance Program, so it's an extremely successful collaboration, so thanks for all this. So I guess this graph allows us really to start directly discussing this topic, and we see the different components. So I guess what is important is to see the operating expense is 50% of the interest yield. So when we talk about fairness of interest rate, we should not forget that this is a large component of it. So 14%, where does it come from? What does it mean, of course? We know that, as we've heard in the introduction, we give small loans. Small loans are expensive, of course. But that doesn't mean that it's enough to stop there. So one response would be that we need really to try to decrease this operating expense as much as possible. And that's part of it. So I guess a fair interest rate is also an interest rate which is related to as efficient operation as possible. So that's one element. Then you have a second element, which is the issue of profits. Of course, what we see here is that it's about 1/10 of the total interest yield. But it's not always like that, as we know, and we'll probably talk about some cases later related to institutions that charge, or that book higher profits or margins also. I mean, of course, the most famous one is the one in Latin America, the largest micro institution in Latin America, Compartamos, which has pretty high profit margins. And we know that in some other countries, in Asia, for instance, you have a lot of micro institutions having a lot of profits. And in this case, when we have institutions with a lot of profits, we know that this is a minority of institutions, that many institutions are still not able to cover their cost. But for these institutions, it's important because these are large institutions very frequently. So that means that it's important for the sector. A small number, but large in terms of size, meaning a lot of clients. So this means that for this case, then we have an issue of distributive justice, meaning who benefits from the microfinance activity? Is it the shareholders of this institution? Is it the staff? Is it the clients of the institution that get better off? And that's, I guess, important when we address this issue of fairness, because we've assumed long in microfinance that the clients would always benefit from that. You know, if the clients come back, if we are still running this microfinance operation, it means that it's good for the clients also. You know, this example of the lady, selling tomato in a market. She buys this tomato for 1 in the morning and she sells them back for 2 in the evening. Imagine the return is just huge, and these 25% interest rates are very small compared to the annualized return that she makes. I mean, imagine 100% in one day what it means. But it's not always the case also. And we've seen with the latest impact surveys that microfinance doesn't always mean poverty alleviation. It can sometimes when it's done in certain ways. When you have, for instance, non-financial services, we know that savings is also important, for instance, for the poor. So it's not always the case. So there's, in one word to conclude, what would be my definition or what my conception of fairness? It's very difficult to define it. I think the first element is a question of coherence. So what do we mean about coherence? What is the mission statement of the institution? What is the mission? Is it really, which target are we talking about? So that's something important. The status of the institution is important. Are we talking about a microfinance bank paying taxes? Are we talking about microfinance NGOs? We know that in most cases they don't pay taxes, for instance. The non-profit organization, for-profit organization. So that makes a difference also. And I guess these are the two important elements, and probably the third one would be, in some cases, we have like we call non-trade-off problems, meaning like the non-financial services or the savings, for instance, could be extremely relevant, extremely important for the poor, and not so costly sometimes. It depends how they are organized for the institution. So what is important is to do everything to maximize the impact also.
Okay. It's indeed just one picture of the whole world that you see here, but I would like to go in microfinance, you look also to trends. You don't take just a picture at one certain moment. And just go to the next graphs. Aldo, what is it? This graph represents the following. If you see over the years, is microfinance growing? That's one theory. When microfinance grows, interests will go down. That was one of the theories. But if you see, and forgive me if I'm wrong, but looking from 2004 till 2011, it went down with only 0.4% looking to the world. And even it went down very quick in 2 years, but the last 5 years it even went up a little bit. Another thing on this graph, looking to all the other places in the world, it looks that the blue seems to be around the bottom line. Is this, first question is this where we are heading to, that the trend is we are landing around between 23-25%? Or how do you see the future on the trend? Aldo.
Thank you, Kurt. First of all, I thank you for the invitation. Of course, I'm very glad to be here. Well, as you have heard, I represent a rating agency, and I would say we have a privileged point of observation of the market. We look at the performances of microfinance institutions directly. We look at the operations, and we can see it every year since a rating is updated frequently. So we can also sort of feel the trends. And here, your question goes exactly to the trends. Of course, according to our data, our database is basically reflecting what are also other studies reflecting. For example, a recent one from CGAP and Rosenberg, and I think this one is taken from that. So basically, during the last 8-9 years, the trend of interest yield has reduced, has gone down, and the main effect is coming from the reduction of operational expenses. So we are seeing microfinance institutions gaining in terms of efficiency. Of course, it's a young industry, so young industries, they always have this kind of path. They go along their learning curve, and they are able to quickly reduce the incidence of their cost. So let's say that since our observation can start at the beginning of year 2000, so 2001, 2002, and from that moment until 2007, 2008, there is quite a constant reduction of the incidence of operating expenses over the interest yield. And again, this is reflecting the efficiency and the benefits in terms of learning process of microfinance institution, as well as economies of scale. But starting from 2007, 2008, there is a flattening behavior of the curve, and then again in 2011. So we are observing a sort of interruption of this tendency, of this trend. And of course, the question is why? Why is this happening? We can think in terms of some crisis in big markets. Of course, we have the Andhra Pradesh case always in mind. We can also think that maybe the sector has reached its bottom level in terms of the learning curve. But again, we don't have sure answers about that. We will see in the next periods. For sure, technology can be a very important element for a further reduction of the operational expenses. I would like to stress the fact that for me, a fair level of interest rates should reflect also to other main aspects. One is the quality of the services and the adaptation of those services to the real needs of the clients. And we cannot forget this element, otherwise we are not able to really compare in the institutions among themselves, and also there doesn't make any sense to talk about trends. So we have to talk about institutions who are constantly adapting the quality of their services. And the other aspect is that a fair interest rate should always reflect the results of improved efficiency, the results of an improved cost structure. And I refer to of course, to the efficiency, but also to other aspects, like, for example, the responsibility, the transparency of the activities, responsible pricing, but responsible operations should consider very, very well the risk of reputation. That is to say, to be always, as much as possible, consistent with the social, there must be a constant coherence between the social mission that the institution is declaring and the operations that they are implementing. and in order to avoid big crises as we saw, for example, in Andhra Pradesh. So when we look at the interest rate, we have to consider all these elements all together and not just parts of them.
Yeah, I hear what you say, like keeping the social mission, but can you try to give a figure? I know you don't like it very much because there's always a but if you put a figure as interest rates, but take in mind that organizations keep the social mission as it is now. How far do you think that we will be when we are sitting here within 10 years again? Just a figure.
As I said, the trend is not fully linear. So there has been a sort of flattening in the last 2 years. We have seen some crises, so these have for sure affected and had an impact on that. But for me, I think there is still room to go down. As I said, I think technology is one important element that we should consider. The mobile banking, for example, is something very important. So I'm not going to give you a figure, an exact figure, but for sure I can say that there is a room for improvement.
Marek, you a figure?
No, but I guess we can see in countries like Bolivia, of course, it's the usual suspect, but it has come down a lot. So I guess for sure we can decrease them by a few percentage, I guess, 1/3, maybe, I don't know.
Now, one of the ways of going down with your interest rates is to leave your social mission. And here is a figure that is also one that you can find in many countries. We took it from recent information from Ecuador. What do you see in this one is the bigger your loans, the lower the interest rate. So here you see all these bubbles, and this is just all individual type of loans. And the bigger the loan, here $15,000, the lower the interest. I must admit, looking to this microfinance institution, that there is indeed a trend, downward trend, but it's not extremely low. And especially what strikes me here is in these tiny loans, and for you, Marek, there is this very wide spread. You have, for the same loans, going from somewhere between 10 to 40, and if you look to on a scale worldwide, it's about between 30 and 70% if you go to the 25th and 75 percentile. So can you reflect on that one, Aldo? Is this the reality?
Well, for sure, this is confirming something that we can always think as a logical issue. I mean, the smaller are the loans, the higher are the costs to issue them and to manage them. In the case of Ecuador, you have a variety of legal status and legal typologies of MFIs. So you have the classical NGO, microfinancial NGOs, microfinancial NGOs basically. Now there is also a new law that are going to regulate them, but let's say their main funding sources are the international investors, and the cost of funds are quite important also, and this is reflected with the higher interest rates. Then you have cooperative savings and credit cooperatives. And in this case, the average operating expense ratio is much lower than NGOs. And also the main funding sources are savings. And savings, in general, they have, on one side, a much lower cost, financial cost, even if they could have, there could be an incidence in terms of operating expenses in order to manage the saving service. But the wide gap that you see in the left side of the slide is because of this variety of typologies. and this variety of business models. Therefore, of course, cooperative can be much cheaper than other kind of institutions.
So you see this also as driver, Marek, that the differences are not really the basic of operational cost, but mainly the differences are initiated by the funding cost.
So that's part of it. But if we come back to your first graph, you see that financial expenses are part of it, but it's not everything, of course. Well, what is interesting here is to see. As you say, when we look at the small loans here, we see like a huge variety. Between 10 to 40 here. So of course the status is part of it, but you also have. It's very difficult because they can offer non-financial services. You don't know how things are done, and we know that it can make a lot of difference. So the difficulty is that we tend sometimes to compare like apples with pears. For instance, Bernd Balkenhol's book on public policy was really interesting in that, explaining us that we really need to have peer groups, benchmarks. Comparing rural institutions with urban institutions. These are just two different worlds. So it's of course very, very important to take that into account. And price is of course the easiest way to compare institutions. It's obvious, it's the signal. Probably we've not taken always sufficient care about the signal in the microfinance sector compared to the rest. That's why I guess also what's happening these days is happening, because probably we ignore sometimes because we are used to that. We know, when we've been active in microfinance, we know that interest rates are high, but I can tell you every year when I start my course of microfinance, not for the student in the EMP, but the student without any knowledge on microfinance, when I put the first bullet point 30% per year, they are all, ooh. So, we are used to these interest rates, but people outside of the sector are not so used to them. So we still have to work a lot on that and make it a priority. The difficulty is that if you focus all the attention just on one element, the price, we may lose a lot of things. Next to the pricing, there are a lot of things. Microfinance is not just offering, microcredit. There's a lot of activities that can make a difference also for the poor.
Okay. In the very beginning, you mentioned the organization Compartamos, a Mexican organization charging very high interest rates, and this could have been a debate on its own today. Just talk about Compartamos and their investors strategy they had. What I would like to do, they charge around 100% interest rates, and when that information was in the world, everybody said, is this still microfinance, and where's the profit going? Do you also mention that one? But I thought this is a debate on its own. But what I would like to show a small video. We will go to the next one. A small video is about the difference in vision. You will see somebody introducing the CEO of Compartamos, defending that 100% charging interest is not that bad. And directly after that, you will see a reaction of Yunus. He was the Nobel Prize winner in 2007. This is also a movie of 2007. And you see both visions on interest rates. Next to each other, it's only 150 minutes here.
Sam Daly-Harris heads the Microcredit Summit campaign. He says every penny more the poor can keep in their own pockets makes a difference.
When women are charged 100% interest, it makes it more and more difficult for them to make the changes that other women who might be paying 20% or 30% interest are able to make.
But Labarte argues that if their clients didn't see the value of these loans, they wouldn't keep returning for more.
Clients vote with their feet. 88% of our clients come back for a loan. Talks about, we're doing something right.
Just to have access to this credit.
Just because they are willing to pay, I don't think that's a justification. If you call it microcredit, because microcredit has a philosophy. Microcredit has a purpose. Purpose is to help people get out of poverty.
Mohammed Yunus knows a thing or two about microcredit. Over the years, his Grameen Bank has made loans to some 7 million borrowers in Bangladesh, most of them impoverished women. That work led to last year's Nobel Peace Prize.
When I run a microcredit program, I can choose whatever interest rate I will choose, and people will borrow because they are in desperate situation. That's how moneylenders flourish everywhere in every country.
So, looking to that, it looks like it's a matter of choice of business model, that you say if we really would like clients, perhaps the first question, Aldo, looking to clients, the first said, look, people come back, 85% are renewing their loans. So if it's so bad, they wouldn't have come back. You from Microrate, you work in that business and you do not only the ratings from the institutions, but you go also do the surveys, client surveys. Is this really the case? Clients don't really worry about the interest rates.
I think that my friend Damien von Stauffenberg, if he hears that you are calling me as Microrate, he will not be very happy.
Sorry.
Anyway, look, we have started doing something called social ratings since 2005, 2006. And the social rating service and product has become quite popular, especially in the last years, because after a lot of adaptation and evolution of the methodology, also within some very good and excellent tables of experts like the Social Performance Task Force and others, the Smart Campaign, etc. Today we are able to, with some indicators, to measure the level of the responsible operations of an MFI. So I think this is really the focus. So when we talk about the level of interest rates, if it is fair or not, if it is an abuse or not, of course we have always, first of all, to put everything into the context and to put the specific operations of that MFI into the context of operations and into the context of the concept of responsible finance. So at the end, I would say that of course, microcredit has a philosophy, as Mohamed Yunus affirms. But within this philosophy, I think there is a due to the client. So microfinance institutions, they have to be permanent. They have to aim for sustainability in order to assist the growth of the micro-entrepreneur from informality to a better off situation, a more stable situation. And this requires many different services, many different moments in which this service is provided. And this is requesting the development of the institution in terms of quality of service, in terms of risk management. Because, of course, as we saw at the very beginning, the interest rate is made by different components, no? So the operational cost, but also the level of risk of your portfolio. So if you're not able to manage all these parts, at the end, you are not assuring permanency of your service and the quality of the products to your clients. So we have learned from our activity to see a huge typology of very different situations. But at the end of the day, I can say that compared to 5 years ago or 10 years ago, today we have something very important in our hands, which is the capacity to measure the level of responsibility of an MFI.
Looking to the clients that are charged these interest rates have to pay, and the person from the Microcredit Summit, he says every penny that a client can keep in the pocket is important. Philosophy, indeed, microfinance is philosophy, like Yunus is saying, but it seems that philosophy alone will not bring down these interest rates. And it looks, Marek, to you, is this, say, competition between institutions? This, at the end, will be the main driver. How do you see that one?
I mean, partly. In some cases, we've seen that competition has enabled, or has pushed or has forced institutions to decrease interest rate. Again, Bolivia is one case. We have other cases. In other countries, it's not happening already. Like in Bangladesh, for instance, we see that interest rates have not decreased so much. It could be competition related to the different products rather than really competition in terms of interest rate. Just let me answer, the last one on compartamos, since you know that I've been working on that also, and I guess it's important on the question of fairness. This issue, the argument of compartamos, of people repaying, of course it makes sense in the sense that if people are satisfied, I guess it's important, and it's a signal also that they value the products. But theoretically, the academic person that I am is not fully satisfied with it, since imagine an institution entering a place where you have only money lenders charging 1,000% of interest rate, and they start offering 500% interest rate. People lending may come back, taking this loan, because the counter, all the alternatives are already 5 times higher. Does it mean that it's a fair, interest rate? You see that theoretically, or if I take another example, imagine that you have a region where everybody is unemployed, and you have one guy coming and saying, okay, instead of earning no money, you're going to get 200 euro per month, and then would it mean that it's fair because everybody would take it while the counterfactor? So we need to take the regional situation into account also. So just thinking theoretically in terms of demand, I guess, is not sufficient. That's why I guess it's more complex, and we raise other issues related to that.
So you are saying now, if there is more choice, then we come to competition, then this will bring down interest rates?
Not always. It helps definitely in some cases where we can push, institutions to compete on prices also. So that's something which is interesting. The risk is, of course, that when you have a lot of competition and when staff have incentives related to quantity, we may have over-indebtedness when staff, just try to have more and more loans without looking at the quality of portfolio. We talked about loan loss ratio here, repayment rates. Of course, when you have a lot of competition, you have a risk of over-indebtedness, multiple lending. That's the story of India, for instance. So competition can be positive. It forces institutions to decrease interest rate. If it forces them to innovate, as Aldo was saying, there's a huge need for new innovations and scaling up of innovation. We talk about mobile banking. M-Pesa is one, but we're not yet able really to scale up mobile banking all around the world, at least relating it to microfinance. So competition can be useful for that, but there's a risk if we don't control competition, if we don't have more credit bureaus when we force institutions to compete, it can be even counterproductive. So we need to be careful with that.
Okay.
And the case of, you mentioned the case of Bangladesh. Bangladesh, of course, is a country where microfinance sector has developed quite a lot, and it represents a very big percentage of the financial system. But there, we have seen, despite big competition level, the interest rate level has not reduced so much. And one of the reasons is that actually microfinance institutions, the biggest ones, are competing among themselves mainly on the quality of the products. So maintaining the small loan size, which means attending the original target that they are declaring in their social mission, and improving the quality of the service, improving the adaptation of the service. So the real competition among them is on the products that they are offering, and not really on the interest rates. So they are attracting clients, more clients, according to the diversification of the offer that they are able to produce.
Right. There is one question I will come back to you after this small second movie, because there is one specific product that we have to talk about, and that's about agriculture loans. But that one is after the movie, because first I would like to go to one other driver. When loans are not going down, the interest rates automatically, or by competition, or by philosophy, or whatever, some people asked also, is this not actually a role for regulator? Is this the regulator who has to say, we have to cap interest rates, we must, from government side, we must make sure that that people are not exceeding a certain number of interest rates? level of interest. So we will watch the reaction on that one, on the interest capping, by the author of the document that you received at the entrance, Richard Rosenberg, and he's talking about his vision on capping of interest rates.
Always pressure to impose interest rate caps, and usually if those caps are going to be imposed in a political process, they will be imposed at a level that's so low that there's just a bunch of tiny loans that you cannot make sustainably. Those interest rate caps tend to have the effect of squeezing people out of the lower end of the market.
So he's saying, don't do that, because you are squeezing people out of the lower end of the market. Aldo?
Well, a few days ago in Bolivia, they have approved a new law, and it appears, well, we are still waiting for the regulations and the procedure, but the new law is introducing an interest rate cap in Bolivia. And we have said that Bolivia is probably the most or the clearest example of interest rate reduction along the years, and a lot of competition. Is probably the most developed market in microfinance in the world. So in that case, well, of course there are several reasons, political reasons. In that case, they have put an interest rate cap, despite a high level of, I think, awareness of that issue by the regulators and the different players there. Maybe in the case of Bolivia, the risk that Richard Rosenberg is mentioning here is limited because of the good capacity of the market to increase efficiency and to therefore to reflect this in the interest rate trend. But generally, I agree. I mean, interest rate caps are probably reducing the outreach capacity of the industry, and maybe limiting a little bit also the creativity that this market has always shown in terms of different business models, variety of services, but mainly the capacity to reach out very deeply. Mm-hmm. And of course, I think Marek mentioned this earlier. In general, what I see, according to my experience, our direct experience and observation on the field, is overall quite a limited capacity of regulators and supervisors in the countries to supervise and regulate microfinance. So indeed, we need to strengthen infrastructure in order to also to obtain a lower level of interest rates and a better quality of services.
And about systems, you talk, for example, about linked to over-indebtedness, credit bureaus. Do you think that would be a way of doing? How is this evolution in the world of microfinance?
This is also still going slowly. There are, of course, good examples and good evolution in some countries. There have been introduced credit bureaus. The main problem sometimes is that MFIs are not able to participate into the credit bureau. So the credit bureau is there, but the main participants are banks because of the system, the software accessibility, the cost. So there are several elements that are limiting the microfinance institutions to contribute and to benefit out of the credit bureau. But indeed, this is when I refer to infrastructure, I refer also to credit bureaus these days.
And you, Marek, how do you see the best role a regulator can play?
I mean, I guess credit bureaus, just and I'll get back to your question, is important, but I guess also, I mean, many MFIs were not willing sufficiently to go for that. I guess we have something like undermined probably the political risk. And why is it coming now? It's because, I mean, we've been talking about credit bureaus for 5 years, 10 years, even more probably. And we don't have enough credit bureaus today because in some cases they don't want to share information. Of course, these are sometimes strategic information and so on. And of course, when we don't have that in place, we should go a little bit faster on that, and I guess we didn't do that. So that's one element. So regulation, I guess, I mean, most have been said. The risk is that people don't have the knowledge, that it can be extremely harmful to the sector. What is interesting is, like Aldo just said, in the case of Bolivia, when you have people who are extremely knowledgeable, then it could be less riskful for the sector. And in this case, sometimes when you have, like, if we remember the Ecuadorian case, when you have extreme cases, and if the ceilings is not so low, then it could include what we would consider that as consumer predatory lending. So that's why probably we've also sometimes oversimplified the debates about ceilings sometimes in the sector, saying that it's always bad, and it's true that it's extremely dangerous because in terms of rural clients, extremely costly clients to serve, I mean, there's a high risk that these clients will never be served anymore, except with cross subsidies or I don't know, but still, I mean, when we see what you showed us in Ecuador, the huge gap, I mean, like 4 times more. If people are extremely knowledgeable, then it's probably less risky, but in general it is. That's what I would say. So there are other tools that the regulators can use, promoting, I mean, transparency. We know it's difficult, but that could be helping institutions to increase efficiency, helping them to access cheaper source of funds also. I mean, Apex, again, if they are well managed, could be helpful for that. So there are other things next to caps that could be useful.
Okay, thank you. And then I would like to go really to the product. We had talked about microloans, but there are so many different products, and it's indeed true. When you showed in the very beginning, you talked about a tomato in the morning at the trade. You sell it at a double price in the evening, then 30% is not a problem. The petty trade, that goes very well. But then you have many people involved in agriculture. And in that one, you need another type of loan, that the money is not turning that quick, much more risks and a huge demand. I would like to have both of you. How agriculture is, according to me, still, and not according to me only, of course, underserved. And I think that will be important in the future to look at. I would like to start with Aldo.
Yes, I agree. Agriculture, micro-lending is one of the most challenging products, I'd say, and it requires quite big attention in terms of management. What we see good institutions who are very, very actively and carefully balancing their loan portfolio concentration into rural and urban lending. And I think this is always a good rule, the diversification, which is, of course, very much valid also for microfinance in order to limit and reduce the exposure to risks. When an MFI is able to balance between different kind of products, it is able to reduce the risk exposure. It is able to benefit out of cross-subsidization. For example, there are some products who are earning a bigger margin because of their cost structure, because of their risk exposure, and this bigger margin can cross-subsidize other products that have bigger risk exposure and a heavier cost structure. So cross-subsidization among different products is very important, and the capacity of the microfinance institution to analyze the yield rate by product is very important. And of course, it is important in terms of funding matching. I mean, if you want to issue and to offer, for example, longer-term loans, like typically agriculture lending products, you must be able to include among your funding sources those who are of longer term. Therefore, you can match your asset and liability. So it is a matter of good management. It is a matter of good strategy and good management of the concentration of your portfolio, and this is fully aligned to what I was saying before. So the importance of product quality and product adaptation to the different needs of the clients. A client evolves. It is growing together with the microfinance institution, and clients' needs are changing. So as an institution, as a service provider, you must be able to offer a variety of services in order to keep the clients and to reduce your risks.
And for me, can I say it like that? What do you think about the model of this? I make it a little bit extra, like highly profitable consumer loans in an organization in order to cross-subsidize for the less profitable agricultural loans. Is that the future, to go further down to that kind of sector?
Partly yes, in the sense that we need to have different types of loans. That's for sure. I mean, we've restricted, of course, the model mainly to productive lending because it's the one where we have less risk of over-indebtedness, but there are a lot of needs, and we know that we need also to offer these type of services. I mean, what we know probably is that we have underestimated the differences among clients in terms of returns also. I mean, we always thought that the demand was inelastic, basically, that, you can increase interest rate anyway because of the alternative. The alternative would be much higher interest rate with money lenders. It doesn't mind. No, I mean, we've seen with this research, extremely good research, such as the one by Deheja, Montgomery, and Murdoch recently published, that there is some elasticity, at least sometimes. And of course, it makes sense theoretically also that the poor, I mean, if you really increase interest rate, it can make a difference. And that's related to another stream of recent research, which is related to the return. I mean, we've seen that we've always assumed that, all our clients would be like this woman selling tomatoes. It's not the case, We have also clients with lower returns. We have some recent research also showing that in some cases, some kind of microfinance clients also had very limited returns. And that's important when we know that interest rates are still high. And that's important when we talk about agriculture also. So and that's something we need to take into account. So, I mean, is crop subsidies everything? Of course, it's part of it. I mean, and I talked about it in other support. But it's true that if the final business model to finance agriculture is to have a lot of returns or a lot of margins related to one type of clientele, the lady selling this tomato, I'm not sure that's the way to go, like trying to increase interest rate. I'm playing the devil's advocate, but of course, if you have to increase interest rate to this woman selling tomato, I mean, you can raise the argument of Sam Daly Harris. I mean, to which extent is this woman not willing to have these additional pennies? So it's probably part of it. It can solve some of the issues, but we need to work on this. I mean, in Europe, in America, we can offer some, let's say, affordable source of financing to the farmers. I mean, why not doing that also in other continents? I know that it's controversial. I know that we need to do that in a way which does not prevent all type of new actors to offer them financial services. That doesn't prevent any type of competition or entry of commercial actors. But at the end of the day, it makes sense that people with very low return, and when we know that agriculture finance a large part of the people who are hungry today, it makes sense that we work a little bit out of the box, I guess, for these clients.
Okay, thanks very much. And then I would like to open the floor for 2 or 3 questions from the public that we take together for our guest speakers. Somebody, the mic, I see 1, 2, 3, okay, 4. Emmanuel?
Hi, Emmanuel Moyat. I'm the coordinator of the ACP EU Microfinance Program, European Commission program. I would like to starting with the interest rate cap, just a suggestion. There is a country called France where we have an interest rate cap. And the interest rate cap is calculated related to the interbanking rate. So it moves. What we just say is that there is an additional margin that needs to be taken by the financial institutions so that they can work at a profit, and that relates to the cost of funding. But there is then a margin. So what I would like to suggest is, if we do need to have an interest rate cap, I hope, and this is not the case in most countries where there is an interest rate cap, and I'd be curious to see how they do that in Bolivia, that we just set what I would call a fair microfinance margin compared to the cost of funding. You see what I mean? So it is not that an interest rate is just an indicator. It's not fair or unfair per se. It is fair if you compare it with the amount of extra work and extra costs you need to implement microfinance. And this also relates to the type of product you do. If you're in consumer lending, if you're doing rural finance, if you're doing finance for small business with a high and quick turnover. And I think this could be an intelligent approach to it if you need to have an interest rate cap. If you don't have a cap, then you could have all kind of institutions doing all kind of interest rate. And I would agree, Compartamos is offering a service. Compartamos has a market because they are much cheaper than the money lender. But in that case, I wouldn't call that microfinance. I'm perfectly happy with Compartamos, but not Compartamos being called microfinance. And being at every microfinance conference and being, social performance and so on. And also, and this is the Commission's, well, not the Commission's point of view, my point of view, from a donor perspective, is those institutions don't need any public money. So this is another discussion. Thanks.
I have a question here from Bob. I will take the 4 questions at once and then I leave.
Thank you. My name is Bob Brager. Of course, I agree with Mohammed Yunus that the mission of microfinance is to moderate its sustainability and its commercial needs with its social mission. But it's impossible to talk about moderating interest rates without talking about the costs of conducting microfinance. And it's impossible to talk about the costs of conducting microfinance without talking about the costs of capital. And if you talk about the cost of capital, you have to ask the question, are investors and lenders to microfinance moderating their commercial mission with the social mission? Because the number 2 item on the first chart we saw in the operating cost of an MFI is the financial costs. So I'm wondering if any work is being done now on that particular question.
Thank you. 3rd question.
Good morning. I'm Patrick Sappi, one of the co-founder of a little microfinance institution in Belgium. Mm-hmm. I want to raise an issue that has not been raised by Aldo and Marek. It's just about the business model of microfinance institution, because if we agree that microfinance institutions should focus on their social mission, if we agree that microfinance institutions should offer fair rates to their clients, if we agree that microfinance institutions should lower their cost, and particularly their operational cost, who pays the difference between a fair interest rate and the real interest rate that should be? And that's probably a tricky question, because a lot of microfinance institutions want to be sustainable in charging large interest rate, and are personally against high and very high interest rate. But the problem is, who should pay the difference between the real interest rate and the fair interest rate that should be charged to clients? And that's a tricky question.
Okay, thank you. And then the very last question.
Thank you very much. My name is Antonie Koning. I'm here from CGAP, and I want to congratulate you for the debate. I think you've really touched upon all the key issues in this debate, and of course, taking a pretty controversial topic is always good for discussion. I really appreciated bringing out in this discussion the issues of apples and pears and the differentiation between products, client needs, and also in fact, the institutions. And I think what we would have to emphasize in this discussion is that there is need for a whole range of institutions, a whole range of business models that are not all the same and don't all have the same social mission and objective. So the word microfinance institution, I think, is often too much generalized. And in fact, the market needs a whole range. Another point that I'd like to emphasize in the discussion is the need for transparency and really the role of the regulator there. I don't think it's fair to expect that all the financial institutions across the world are going to be as transparent about their cost and rates, as you explained at the beginning, of prices that factor in a lot of issues. So there I think we do need to step up regulators' activity. And just to emphasize again, I think this is a market. We are talking about demand and supply, and I'm not necessarily saying that the demand that Comportamus is talking about is sufficient or good enough, but it is in fact something that clients and businesses need to work out together. So my question is actually building on actually all the three previous interventions. It's kind of building up to the same point, I think. Then what is the role of public funding in this? If we accept that financial services, as I think one would accept in Belgium, is a private sector activity with clients that have a demand, with institutions that provide a service of which quality, as Aldo rightly pointed out, is a very key component and responding to the needs, then what is the role of public funding? And I would argue, and I think not just the public funding, but also the social investors here, that truth in advertising is a key element. But I'd like to hear the voice of the panelists on this. Thank you.
Yes, thanks very much. I will not be that fair this afternoon to give you, as I told you, we had so many questions that we can fill another afternoon. But what I would like to propose to Aldo, that you take question 1 and 3 together on the interest cap, and especially also to focus on what Patrick Sapie is saying at the same time, is who is paying the difference, if you can take both questions together.
I think that, as I think I said, today we can measure something more than we could do in the past. Also because the industry has converged, has agreed on some standards of reference, and I am referring, for example, to standards for responsible finance, for transparency, for product quality, for client protection. So all these elements are playing a big role when we talk about fair price, when we talk about sustainable price, and also when we talk about the difference between fair prices and sustainable prices. We are more equipped today to identify if in that specific case, and I repeat that we have a variety of situations, there is a wide difference between microfinance institutions and contexts. So today we are much more equipped to say and to identify if that price which is applied in that specific situation can be defined fair or not, according to different indicators that have been recognized internationally. And further than this, we can say and we can measure the level of client protection as well, because this is all about client protection. No? We're talking about interest rate in the sense that to understand if client is really protected within this kind of market and this kind of sector. So my conclusion is that we can discuss a lot about interest rate caps, about the fairness of the price. There are different perspectives, but for sure it is important also to have some standards and some tools that are now allowing us to say something which is discussed through a common language among the stakeholders. And we must involve regulators and supervisors in this discussion and in this kind of new vocabulary. I think this is going ahead. I have seen already some good reactions from regulators. Some of them, well, I go back to the case of Bolivia, on the new law, and in the new law,
I know.
But it's difficult. And
not go back to Bolivia, I think that will take us...
I know, but in Bolivia, it will be mandatory for regulated MFIs to produce a social performance evaluation, third-party evaluation, where MFIs are really showing their coherence with their social mission and social indicators that are referring to what I am saying here in terms of responsibility, transparency, and fairness.
Okay, thank you. And for you, that was the last question, combining the role of social responsible investors and social investment for public funding.
Mm-hmm. So I guess
also 1 minute for you.
So two terms for 1 minute. The first one is coding out. Of course, we don't have Damien van Stauffenberg, but still, I mean, this issue of socially responsible funds or financing or donors, let's say, financing people that could be financed by socially responsible funds, and so on and so on. So I mean, that's one thing, and it's still not yet solved. Let's say, I mean, in many countries you still have donors that are financing institution that could be financed by, let's say, more commercial actors, talking about Compartamos. I was reading on one article when the director of Compartamos was saying that even donors were still queuing, it was a few months ago, in front of their doors to give them, some concessionary loans and so on. So that's one element. So the second point, and maybe that may even be my last words to help you, is that, of course, when we talk about fairness, we talk about values. Fairness is related to values. When we talk about what we mean by having fair or responsible practices, we talk about certain values also. And what we see today, and that goes a little bit in line with what you say, is that sometimes the values, the way we define fair in microfinance, is not totally the same as other stakeholders, maybe regulators, define fairness. Because we've been in the sector and considering some things as normal, so while other actors do not always consider them as normal. So that's something extremely important also, because the way we will define what is fair depends on these different values. So we need to talk to them, we need to address them, and that's also why I believe that participatory approach also at local level are extremely important, trying to make things understandable, trying to make things agreed by local populations. Of course, in the case of cooperatives, it's easier. But more generally, I believe that one way to solve this issue will be done through this participatory approach with regulators, but more generally at local level with clients.
Okay, thank you. Then I would like to ask, that was the question when we start today, interest rates, microfinance, abuse, necessity, or something else. And this time, both of you have 20 seconds to answer that question in a very quote way. Aldo.
To me, clients are at the center of the picture. We have to be sure that clients are both protected and happy. Not necessarily a protected client is an unhappy client. Today, we can more easily say if a client is at the center of the attention of an MFI. Today we are more equipped.
Abuse, necessity, or something else?
So it was necessary, I guess, to build an industry, to make it possible, to create things, but it's necessary today to really focus and make it a priority in the sector to decrease them.
Okay.
20 seconds.
Exactly. Thanks very much for your interventions.
Thank you.
Then I would like to invite Thomas Leysen, Chairman of KBC Group, for the closing remarks.
So let me thank in turn our speakers for contributing to the debate in such an incisive way and really shedding setting different perspectives. And I would also like to thank Kurt for not only moderating the debate, but for actually setting up this new format, which allows us to hear within one session different voices, different perspectives, get at the subject through different angles and hear different philosophies. So I think this was a very useful innovation, and so thank you to all three of you for making this possible. So I'm not going to try to summarize everything that has been said here. Let me just give you some thoughts that arose from this debate in my mind. And maybe I think as in many instances, a useful angle to look at this question, are interest rates here too high, are they abusive, or are they necessary, is really through this angle of sustainability, and this word has been used a couple of times by different speakers today. Clearly for microfinance to be sustainable, to work in the long term, to really work as a concept and fulfill its role, it needs to be sustainable in the long term, and for it to be sustainable, it needs to be sustainable for the clients, because if interest rates are of such a nature that they push the clients into problems and to excessive defaults rates, then this model is not going to work, and let alone that it will not fulfill its social purpose. On the other hand, if the microfinance institution cannot cover its costs, it's not going to continue for a very long time either. So the question of whether interest rates are too high, are too abusive, or are just about necessary, can only meaningfully be addressed if there's actually a large area of overlap where the interest rates actually work for the institution and still work for the client. And if there's a large area of overlap there, a large spectrum, then you can talk about whether rates are too high or too low. And in that space, my personal suggestion would be that the best way to actually keep the market honest is a degree of competition, and maybe that's my free market instincts, that I would tend to see that blunt instruments like interest rates caps are less useful and less sustainable in the long term, because they very often have adverse effects than actual degree of competition. And so I don't know about the interest rates of compartamos, whether they are too high. They sound pretty high to me, but if they are really so high that they will create excessive profits for the organization, then I guess competition should move in and will move in and will address that. So that leads me maybe to the other thought about the different models, and again this has been addressed by a number of speakers and interveners, is the question of the model, should it be for-profit organizations? Is there a role for, what's the role for non-profit or socially responsible investors? Clearly, it seems to me that today the space is still so big, the need is so big, that there's room, and there's not only room, there's need for all these different actors. But again, if we want the industry, or the concept of microfinance to be really sustainable in the long term, it's probably its best guarantee is that for-profit organizations can also be sustainable in that. Clearly, there's a role for donor money, and there's a need for donor money. But if a economic concept is self-sustaining on a purely economical basis, in the long term, that's probably its best guarantee for sustainability and for continuance into the long-term future. Because if you're reliant on structural donor flows, there's always the risk that these will dry up at some point. So, and that brings me to maybe a final point on the On the cooperative model, it has only been touched upon very briefly, but I think that's probably a very powerful concept. And obviously speaking here as KBC, which has this association with the cooperative world through SERA, you will not be so surprised to hear it from me. But this cooperative model is actually probably a very good way of bridging these two concepts, because also it allows to build up this local funding, which again would help the funding structure of these microfinance institutions, and thereby also enhance their sustainability. And lastly, maybe on this last debate on agricultural loans and their particular challenges, I don't think we have all the answers to hand how to address this question. Again, I think cross-subsidization, which has been mentioned, is a concept which can help certainly in an initial phase, but again, that's not a very sustainable concept to engage in business activities which are in itself not profitable and take profits from somewhere else to sustain them. So we need to find other answers, and the only thing I can say there that certainly BRS and KBC supporting it is really willing to engage in that debate, which we think has to be a multi-stakeholder debate, which involves other NGOs, the governments, other institutions, to find the adequate answers for this really important challenge in the agricultural sector. So these are the few things I wanted to share with you, having listened to this very interesting debate. And let me now invite you for the second part of this microfinance lunch break, and that's the lunch part. Thank you very much.